following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. That rocking tune means it is time once again to get you into peak options trading shape. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing around here we like to refer to as the Options Insider Radio Network, upon which many of you are probably listening to this fine program right now. And as a man said in the intro, I am joined on the old Options Bootcamp drill instructor squad, first off, by my usual white-headed co-drill instructor, Mr. John Critchley, the options major domo over there at sogotrade.com. John, welcome back to the show, sir.
Hi, Mark. How are you? We have the kiddos back in school this week. We got some volume picking up, and so all is just fine and dandy in New York City today.
All is fine and dandy in New York City and in Chicago as well. And unlike, as the man said at the top of the show, we are not joined by our usual black-hatted compadre, our drill instructor friend, Mr. Passarelli. He is off on assignment, but we have an excellent and able stand-in. He's got his whistle. He's got his drill instructor hat ready to go. He is Randall Liss from the Liss Report. Randall, welcome to the program.
Thank you, Mark. Thank you, John. Good to be here. My name is Randall Liss. I was a market maker on the floor on the Amsterdam European Options Exchange for 15 years, and I'm now in the options instruction business. It's my great pleasure and privilege to be here.
And, of course, we here, myself and Dan and John, all bring the American market maker perspective to the show. You're gonna broaden our horizons a little bit, Randall. Bring that European market maker take to the mix. Because all you guys trade over there is European options with no early exercise, right?
That is not so. The European Options Exchange is an exact clone of the CBOE.
That was a little inside baseball options humor. I think 3 of our listeners laughed at that. But it was all right. It was all right. We'll take it. All right. And with our team assembled, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, everybody, welcome to the basic training segment. This is, of course, the portion of this fine program where we introduce you to some basic options concepts. And now, John and I were chatting before the show about what would be a good topic to visit on this, the 30th episode of this fine program. We went back and forth. There's still a lot of great topics out there for us to discover and for us to dive into and really sink our teeth into here on the old program. A lot of you have written in with some great suggestions. But we kept coming back to this one idea because it is here, as we're recording this, it is back to school time here in the States and indeed around the world. And so we thought, what better time to go back and review and refresh ourselves on some of those basic options concepts that we hit on all the way back in episodes 1 and I believe 6. It's been quite a while. Since then, the show has grown quite a bit. We've added quite a few new listeners to our audience, so we know a lot of you have had a chance to check out the archives. Some of you have maybe only heard a few of them, so we thought, what better time to sit everybody down and kind of do a review of the basics of options. So that's kind of what we're going to do today. We're going to start off with the basic options concepts and principles, then we're going to roll them into some basic positions, and then we're going to get going from there. So we'll kick things off very, 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 very top of the options heap, the old basic, what is an option? If you're listening to this show for the first time, you're scratching your head, you're saying, what is this option thing you're talking about? We're talking about a contract that gives you the right, but not the obligation. That's important. You don't have to do anything. It just gives you the right to buy or sell a particular underlying. We usually talk about stock options here, but sometimes index options. They could be futures options, commodity options, whatever the case may be. A lot of different flavors of options out there to buy or sell a particular underlying by a particular expiration date. That latter part being very important, of course. Options differ from stock in a lot of different ways. One of the primary ways being the fact that they have that expiration date. You can go out and buy IBM and hold it until you retire. That's not a problem. If you buy an option, it has an expiration date. It has to be good by that date. It has to move in the direction you want. The volatility has to develop. The spread has to develop. Whatever you want to happen, it has to happen by that expiration date. So that's something that a lot of newcomers to the options space and the options product tend to have a little bit of a hard time wrapping their heads around, the fact that their trade actually has a ticking clock attached to it. Of course, options come in two very basic flavors, calls and puts. Calls are bullish instruments for the most part, at least when a lot of options novices come to this market for the first time. When you buy a call, it makes money when the stock goes up. It gives you the right to buy a stock at a particular time. The put is the opposite of that. The put gives you the right to sell a stock by a certain date. So as you might imagine, that option makes money as the stock drop. If you lock in a certain selling price, let's say 100, and the stock drops to 80, guess what? Your selling price is better. It's $20 better than what the market is trading, so you have $20 of value in that option. So those are the two basic flavors of options. Now I think maybe we'll get into some of the mechanics here a little bit more, the underlying principles of options. A lot of things people have a hard time wrapping their heads around when they first come to options is the multiplier, how these contracts work, how many shares of the underlying you're actually going to get when you exercise these contracts. Now, Randall, I know you come from all the way across the pond, so you trade some funky contracts over there. But over here, why don't you walk our listeners through the standard equity option multiplier that most of them are going to encounter in their day-to-day trading?
Well, as I said, the European Options Exchange is a clone of the CBOE. One options contract equals 100 shares of stock, just as it does in America. And one of the things that my beginning clients have a hard time understanding is, for instance, if you sell a put option, you are selling the right to sell. And some people have a hard time getting their head around that. You're selling the right to sell. If I sell a $60 put option, I am obligating myself to buy that stock at $60 should the option holder put that stock to me. Mark made a very good point when he said an option is the right and not the obligation. That is true for the buyer. The seller has no say in the matter. The seller of an option receives premium in the form of the option price in exchange for the obligation to either make delivery or take delivery should the option holder decide to exercise that right.
The one thing I wanted to add is we get questions all the time from the new traders, and Randall hit on about the multiplier. One contract equals 100 shares. That is also what they call a deliverable. So if you buy one contract and it goes in the money and you hold on to it through expiration, you have 100 shares. The standard multiplier is 100. The deliverable is 100 shares. But the thing that our customers get confused on all the time, and I want to touch on very quickly here, is that the deliverable can change. and that changes in reverse splits, when there's a stock dividend, when there's a cash deal. And what we want to tell our customers and customers that with any online broker is that when your underlying goes through a split, a reverse split is really where it's very tricky. Forward splits are easier to deal with. The options then become non-standard. The deliverable or the multiplier is a non-standard number. And what happens on most platforms, including Sogo Trade, is that these options now, at least on our platform, you can't trade them. We block them. And we do that because it's very, very tricky to trade these non-standard options. So that's for the new basic retail customer. Be very careful if your underlying, you have options on, goes through some type of split or maybe a stock dividend or maybe a takeover. It's very, very tricky.
But let's be honest here, John. That doesn't happen very often. It's a rare event.
Well, it maybe a cash deal. That's true. Maybe a cash deal or stock dividend. But we actually, what I'm really referring to is we see, especially with all these ETFs and these the VXX, we do see a lot of reverse splits, and we get a list every day. And there's so many.
Talking about ETFs here. Oi.
Well, I'm just saying that in the option underlying universe, we get on a daily basis, reverse splits, and that's kind of what I'm talking about. I'm just saying that just to tell our customers, retail customers, to be careful. Of course, there aren't that many cash deals or deals with crazy, deliverables, but with the reverse splits, that becomes very tricky for the customer. And I'm just telling the customers to be careful and call your broker, call Sogo Trade if you have an issue, and we'll take care of it.
That's a very good point. But if you're talking about your plain vanilla options on such as things as Microsoft or IBM, that won't really be a factor.
Yeah, the dividend is an interesting point to bring up, and certainly one that can be encountered. And it's usually more for down the road a little bit, and people have started trading. All of a sudden, they encounter that problem. They eventually will counter it at some point, and I'm sure, John, you've received more than your fair share of calls on that point. So a good one to bring up, particularly with the ETFs these days, because they are all different shapes and flavors and different sizes. All right, thank you for that, John. And of course, it is called the multiplier because it has a very simple use case. Let's say you see an equity option that is priced for $4 in the marketplace. Of course, that price is actually for 100 shares of the underlying. So when you want to actually calculate the ultimate price, if you want to go out and buy that option, it is 4 times 100, which is the multiplier. So the actual price of that option is $400 if you want to buy a one lot. So that's why it's called the multiplier. It's used to really figure out the true price of that option. So don't be surprised when you go out there expecting to buy a $4 option and instead it is $400. Now, moving on to another concept. Unfortunately, our black-hatted companion isn't here to discuss the Greeks. This is his bailiwick. He's written several books on this topic. We'll have to muddle through as best we can. Of course, the Greeks are those basic risk parameters that all options traders use to really define their risk variables and to do some very basic risk management. We'll run through the primary Greeks again. Of course, delta, that is your directional risk. It gives you directional exposure. That moves as the underlying moves. So if you have a long delta option, a positive delta option, as the underlying increases, the value of your option will increase and vice versa. The closer that option's delta gets to 1 or to 100, depending on how you're quoting it, the closer that option's price will move to the underlying itself. A stock has a delta of 1 or 100. If you have an option that's very deep in the money, it'll have an approximate delta of 100. So it'll move essentially in lockstep with the underlying. If you have a very low delta option, a 5 delta option, very far out of the money, it's not going to move very much as the underlying moves. So bear that in mind as you're trading these products. Now, of course, moving on to gamma, a little bit more advanced Greek. This is, of course, the rate of change of your delta as the underlying moves, and this gets into a little bit crazier portion of the program. We talked about it a little bit on this show and some of our other shows on this network. Maximizing gamma, doing things like gamma scalping, those are much more advanced techniques. We don't really get into them much here on this show, but it is worth being cognizant of gamma and how it works, particularly how it changes as you approach expiration and how that could impact your trades. Particularly, remember on the last few shows you talked about time spreads and calendar spreads. Gamma becomes a big factor in those trades, and you're really trading a lot of gamma more than you're trading delta in those types of trades. So be cognizant of gamma and how that rate of change of delta in and of itself can change. It can be a very confusing concept to wrap your head around. Now, the flip side of that coin, the other side of the gamma coin, is theta, is the time decay. We've hit on this many times on the show before, a very important concept for a lot of our basic retail options traders to understand. Basically, remember, the options have an expiration date, so they're decaying, they're dying a little bit every day. The closer you are to that expiration date, the faster that decay rate becomes. We've said many times on this show, once you get into those final 2 weeks of an option's lifespan, they are naught but decay. So if you're talking about weeklies, that's why so many people come in to sell the weekly contracts, because they're only 1 week contracts and they have a lot of decay built into them. So they're very attractive from the premium selling sides of the fence. But the time decay being, of course, a very, very important concept if you're writing options, and also if you're buying options, you have to be cognizant of how much that option is going to lose its value every day, so you know how your trade has to perform in order to offset that. And finally, we have the kind of the king of the Greeks, at least for a lot of professionals. That is, of course, Vega. That is your volatility exposure. It shows how much your position is going to gain or lose in value as the volatility, the implied volatility of the underlying, changes. And that is important to know as we're talking about things like spreads, as we're talking about other positions where they are very volatility focused. And I've said on the show many times in the past that basic retail tends to be delta focused. It tends to be very directionally focused. And whereas professionals tend to focus more on the Vega side of the fence and perhaps Theta as well. We like to see a lot of retail, and hopefully our goal for this show is to try to bring some retail away from that just, I think the stock's going to run up, I'm going to buy a call, to some of these more sophisticated and risk-mitigated strategies that we talked about many times on the show that exploit things like Theta, that exploit things like Gamma, and of course Vega. And that's really the reason we're here on this Options Bootcamp show. Now, of course, I said Delta is the directional risk. That's kind of the main focus of Delta. But, of course, there are a couple other definitions we can get into, too. I know, Randall, I can see you champing at the bit over there to get in. So what are your other takes on Delta for our listeners?
Delta has two meanings. Delta can be seen as percent chance of finishing in the money, i.e., an option with a delta of 80 is considered to have an 80% chance of finishing in the money. The other definition of delta is the hedge ratio, which means if I sell 2 calls with a delta of 50, making me 100 deltas short, I need to buy 100 shares of stock under that to be delta neutral. My point is the two meanings of delta. One is percent chance of finishing in the money, and the other is hedge ratio.
All right, yes. Delta. All the Greeks have a lot of different meanings, but Delta in particular has those three. The latter, the hedge ratio, tends to come in for a little bit more professionals who are looking to trade delta neutral, as we said on the show before, where they're trying to mitigate their actual delta risk and try to focus on that pure Vega, that pure volatility component of their trade. All right, moving on here, we're going to talk about some other basic concepts. Then we're going to roll on into our options drill segment. I think one of the last things I want to just refresh our listeners on, Randall kind of touched on it on the top of the show. It is the long premium versus short premium equation for options traders. Let's first define what we mean by premium. It's kind of become this catch-all term in the options space. Essentially, what we mean by premium is the options price, all that inflated value that goes into the options price. So the interest rate, the decay, the volatility, all that kind of fudge factor that builds into the option. So if you're buying premium, you're essentially just buying options. If you're selling premium, you're essentially just selling options. It's become this catch-all term for the whole options price in and of itself, even though it really just refers to that extrinsic value portion of that. Now, when you're long premium, of course, you have a lot of benefits. Your risk is usually mitigated to what you've put out to buy the contract, so that is a nice feature of buying options. If you buy a call for, let's say, $5, the most you can lose on that call is $5. Of course, some of the other drawbacks come into consideration when we're talking about these long premium type positions is, of course, the main one being that ticking clock, that expiration date that is rapidly approaching. So if you buy an option with 2 weeks to go, or if you buy an option with 6 months to go, you have a little bit different clock, a little bit different time horizon, a little bit different time decay that you have to deal with. But always be cognizant of that. Don't go into buying a contract with 1 week to go and then be surprised towards the end that you don't have another 2 months or what have you to actually let that position become fruitful for you. It's one of those things that, like we said, a lot of newcomers to this space have a hard time wrapping their heads around, but certainly be cognizant of the fact that that option is usually cheap for a reason. It's either way out of the money or it's very close to expiration. So if you're buying a very cheap option, look at some of the reasons why that option may be cheap. And it could be that it's expiring in not a very long time, which is something you want to be cognizant of if you're trading that position. Now, as Randall alluded to at the top of the show, the flip side of that coin is the short premium side of the fence. And that gets a little bit more interesting, a little bit more attractive for some people, also a little bit more risky. And this is where we actually talking about just essentially selling options. And it gets a little bit obtuse when you think about selling things like a put, because, of course, you're selling someone else the obligation to sell the stock to you. It's very, very convoluted. And we'll get to some of those basic positions in our options drill segment. But I just want to kind of discuss the mentality that goes into both of them, really. The long premium mentality versus the short. I know, John, I know which way you lean, but why don't you give our listeners your take on the whole long premium versus short premium trading debate?
Yeah, I have a tendency to come from the long premium school, and when I'm finished, I'm sure Randall will tell us what his philosophy might be. A lot of the retail customers that we have actually are long premium buyers, which is kind of unusual for the retail customer. I think a lot of retail customers attracted or they get sucked into this selling premium and options are a wasting asset and it's decaying. You pick it up, but as we said in the past, if 9 out of 10 times you sell an option, you collect money, that one time that you sell it may wipe out all your gains. So we always say if you're gonna sell options, be careful, pick your spots. And just know what you're getting into. I think one of the biggest misconceptions, and we had this in one of our other podcasts, was when you hear, well, IBM is 200, and I'll sell the 190 puts, and the worst case is, I'll own a 190. Something terrible happens. Well, that's not really the case, and people get enticed to sell the premium. So I think, again, pick your spots. And I always say, if you want to sell premium, and we've talked about this in the past, you can do credit spreads or other ways to get your philosophy or collect some premium with, and also be able to manage your risk.
The problem with being long premium is this. The most common question I am asked by my retail clients is this. I bought a call. The stock went up, and I still lost money. How did that happen? It's because options are a wasting asset. They decay with time. One must never, ever forget that. Myself, I prefer to be a net seller of options. Having said that, I always spread. I will never, ever, ever sell options naked short, be they puts, be they calls. I don't like unlimited risk. If I'm bearish, I'll sell a vertical call spread. If I'm bullish, I'll sell a vertical put spread. But I do not like being long naked outright options. Options are a wasting asset. Once again, the stock can go higher and your call can still expire worthless. Options need to be seen in 3 dimensions. It's not just the what, it's the how fast and the when. It's direction, time, and duration.
It's funny you mention the concept of, buying the call, the stock rallies, and you lose money, because I've said this many times on the show. That is still, to this day, the number one question we receive all the time here at the Options Insider. It's pretty much the basic retail trader's introduction to volatility and volatility skew which is something we're going to get to on an upcoming show. A lot of you have written in asking about volatility skew. That's a great question to kind of save for that type of episode. But you're right, it is a very common thing that a lot of basic retail traders encounter, because a lot of them come to the options market and they start buying calls, and they usually they do it around earnings. That's a great time to experience that phenomenon for themselves. And soon after that happens, they write to a guy like me or to someone like you, Randall, or over to John at Sogo Trade, and this educational process begins. And that's where a lot of people usually come to this show after they've encountered that type of experience in their trading. And speaking of trading experiences, it's time to keep on rolling with this show right on into our options drills segment.
Calling boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to our options drill segment. We thought, what better time than when we're kind of going back and doing a review and options primer, if you will, than to get into some of the basic positions and how you can incorporate some of those options basics that we just talked about. Of course, as we just said, the most basic of all options positions, kind of the options 101, the gateway drug, the entry point for a lot of new retail options traders, is that long call trade. They come to the options market, they find an underlying that they may like, they may own stock in it already, they may be trading the stock, and they say, I think XYZ stock is going to run and rally. I'm bullish on this underlying. I'm going to buy this call, which gives me the right to buy this stock at a particular price by some specified date. And they can hopefully, if their underlying rallies, then that trade works out in their favor. It's a nice, very limited risk scenario for them. If they spend $5 on that option, the most they could lose is that $5, and so it's a nice, attractive option. What goes wrong with that trade? Well, many things usually go wrong with that trade. The first thing is that they'll come to the options market, they'll say, wow, at the money, the strikes actually where the underlying is trading, those options are kind of expensive. And those are somewhat, maybe a little bit more than I wanted to spend. I'm going to look at some of these farther out of the money options, and remember we talked about delta earlier. The out of the money options have the deltas below 50. They are, in the call sense, they are farther up on the option chain, that listing of option quotes that you see at your brokerage firm. The puts, the out of the money puts, are of course below the at the money strike. Those are the below 50 delta put options. Now they start looking at those and saying, these are actually much cheaper. I'm going to buy one of these, let's say 20 delta options as opposed to the 50 delta at the money options, or perhaps even the in the money options that are even more expensive. And what happens with those, as we illuminated earlier in the show, as Randall outlined, delta is of course your probability of expiring in the money. If you're buying an option with a 15 or 20 delta, it's got a 15 or 20% chance of expiring in the money. Those aren't exactly great odds. You can flip a coin and do much better than that. So you can see why a lot of basic retail options traders who come to the options market for the first time have some problems. And then if the stock does go their way, if the stock does rally through their strike, now the call is getting to be in the money, or maybe it rallies to their strike, they encounter what Randall just described, which is that volatility effect, that skew, that wasting impact of decay, and all of that volatility comes out of that option, and even though the underlying rally, they end up losing money on that option. So there are many things that are difficult to wrap your head around the basic call. It sounds very basic, sounds very easy to do. You buy a call, the stock goes up, you make money. There's a lot more to it, and that's why we've hit on that many different ways on this show. Now, the flip side of that, and maybe John, you can run with this a little bit, is of course, buy a call, you're buying the right to buy that stock at a certain point down the road. If you flip that on its head, you sell a call to someone else. Now you are selling to someone else the right to buy that stock. Therefore, you are guaranteeing to sell that stock at a particular price by a particular date. So you can imagine how that might change the scenario for your trading. John, walk our listeners through a quick rundown of the short call scenario.
Yeah, one thing I wanted to mention is that, and Randall mentioned it also on the show, is that when you sell the call, you no longer have that right. That right's taken out of your hands. Anytime during the life of the option, it can be assigned to you, but you don't unless you buy it back. If you're short it, you don't control it. Sure, a short call or short put. The one thing I also wanted to touch on was the margin requirements. Now, for most of our basic retail customers, when we first come into the option marketplace, they're equity customers. So if you buy an equity in a cash account, you have to pay for it 100%. If you buy in a margin account, you pay 50%. Well, if you buy an option, you have to pay for it in full. If you sell an option, there's a margin requirement. And for most options, short calls, short puts, the margin requirement is 20% of the underlying instrument stock minus any out-of-the-money amount. Now, the new thing that's not really a new thing, but what's happened recently is that with a lot of these high-flying stocks, the requirement's higher. For example, First Solar, LinkedIn, I can go on and on, Netflix. Their requirements to sell these calls or puts are much higher, maybe 45%. Some are 75%. So it becomes very capital intensive to sell these calls. But if you want to sell a Microsoft or GE or IBM or standard boilerplate or a spider option, the requirements can be 20%. And so once you have a lot of equity in your account, if you're trading a high-priced underlying and you want to sell the 200 strike calls, it's going to cost you a lot of money to sell it. So that's one of the reasons why for the brand new basic option customer with a few $1,000s in their account, it's hard to sell options naked. So you can do spreads or you can buy options, but it's trickier to sell the options because the margin requirement is very high.
Of course, one of the other ways that you can sell options is to go the covered route. And a lot of new options traders, and they look at selling calls, they like to do it in conjunction with selling stock, and they put together that position that has become so popular throughout the options realm. That is the covered call position. Randall, why don't you walk our listeners through the basics of the covered call?
Okay. A covered call means I buy the stock and I sell a call above it. Let's say I buy the stock at 100 and I sell the 105 call at 2. That is the exact same thing as selling the 105 put naked at 7. The great mistake that many retail investors make out there is thinking of the covered right as a hedged position. It is not. Think about it. If I buy the stock at 100 and I sell the 105 call at 2, I have $2 of downside protection. If the stock goes below 98, I lose money. Why would I not, instead of that, sell the 105 put at 7? If I had a whiteboard, I could illustrate this for you, but it's the exact buying stock and selling a call is the exact same risk-reward ratio as selling the put naked.
Listeners, if you're having a hard time wrapping your head around that, we could obviously go into synthetics for the entire show. I encourage you to surf on over to theoptionsinsider.com or wherever you're listening to this program right now and go back to our archives to episode 18, which came out back in March, where we go into the entire joys of synthetics on that show. So there's a full episode of that if you want to hear more about synthetics and how they work and what different equivalent positions are and how you could combine options and stock in various ways to create those positions. But in short, covered call, not exactly the risk-free, risk-mitigated type trade that a lot of people tend to think it is. You'd be amazed, Randall, how many people, when I approach them and I'll say, what do you trade? I'll say, I trade covered calls. And then I say to them, well, did you also sell puts? And they look at me like I'm a crazy person and say, that's far too much risk for me. And then you have to walk them through that whole equivalency synthetics discussion, and then you see their eyes open up. It's an interesting conversation to have with them. John, I'm sure you have this conversation on a regular basis over there at Sogo Trade.
Yeah, the one thing I wanted to add, and maybe I want to get Randall's take on it, is that the benefits of options versus stock. As we go into basic buying calls and maybe covered calls, we had a show on this in the past. Most of the people, almost all the people, when you first start investing, you're an equity investor. Very few, if any, come in the marketplace. Well, I'm just going to trade options. Usually they come from the equity marketplace. So the benefits of options versus stock, which I always tout, and we had a show on it, there's some advantages and disadvantages, but for the straight buying of calls or the covered call strategy, You can also look at the options versus stock. I'm interested to see or to hear from Randall's take on this, the benefits of options versus stock.
Okay. Look, if you want to capture the dividend is priced into the put. If you want to capture the dividend, if that's your idea, then sell a cash-covered put. The dividend will be priced into the put price. And another advantage of selling the put instead of doing a covered right is you have one transaction instead of two. Another advantage is you don't have the cost of carry of the stock. I hate the covered right strategy. I hate it. If you really want to do that, then just sell the put. Any way you look at it, it's bullish.
Listeners, stay tuned for the Randall List Covered Call newsletter coming to a website and a newsletter provider near you very soon. But you're right, Randall. It is. Once you start learning the synthetics and how these things work, of course, the put becomes a more attractive option in many of those scenarios from a capital efficiency perspective and a lot of other reasons. The selling of the put is certainly can be more attractive. Of course, what John was referring to when he talked about the benefits of options, there are many of them. We didn't get into them at the top of the show, but we can kind of run through them here really quick. Of course, when you're talking options, when you buy them, you get the leverage aspect. So you can come in and let's say you're going to buy a stock for, let's say $10, you're going to buy 100 shares. Well, now that's $1,000 you're going to outlay for that stock. You can buy let's say an at-the-money option, and perhaps you can pay 2/3 or 1/3 or even a quarter of that price for that same approximate level of exposure in the underlying. So the leverage component was it really brings people to the options market when they first start off. Then they start learning about some of these other things we're talking about here, about the risk management benefits of it, about the time decay and capturing premium and generating income and maximizing volatility and all of the other things we start to talk about here on the show. And then they really start to wrap their heads around that as well. If you want to dive deep into options and using them with or without stock, I encourage you to go back to our episode 20 back from April 19th, options in lieu of stock, where we kind of run through a lot of those different alternatives and different ways that you can use options with your stock or just to replace it altogether. A great episode for that. And let's see, what else do we have here? Okay, so we hit the covered call. Now, all right, so we hit on the basics of the call positions. Now let's turn it around, look at the put. The put is an interesting position because just by its very nature, it is somewhat a little bit counterintuitive for a lot of people. They're buying the right to sell something. It's kind of an extra logical, intuitive step for them to make, and some people have a longer time wrapping their heads around puts, which is why I always say calls are usually the first retail options trade when they come to the options market. It's just easier to grasp. But the put, of course, gives you the right to sell an option if you buy it, and that, of course, offers a lot of interesting alternatives, particularly from a hedging perspective. If you're a long equity trader, I'm assuming a lot of you listening to this show are, the long put is a very attractive hedging tool. If you're long, the XYZ stock is trading for 100, and then you buy the XYZ put, let's say for perhaps $1, the 100 put expiring in a month or 2 months, then you have a month's worth of protection. You paid $1 for it, so you're effectively locked in. If you price in that $1 you paid at 99, the stock drops below 99, you're safe. So if you're worried about some sort of apocalyptic downturn in the market or in your underlying in the very near term, you can, of course, buy that put, and it's a nice way to hedge and to protect that position. Of course, there's different ways you can do it. You can buy longer-term options to get more protection. Of course, it's going to cost more. That gets back to that time decay factor we were talking about earlier. A lot of different ways you can structure them. Now, what Randall talked about earlier, and I guess, Randall, I will toss it to you to discuss this because short puts seem to be very much top of mind for you today, is, of course, the other side of that coin, the short put. You're now talking about counterintuitive. You are selling to someone else the right to sell that option back to you, essentially. So what you're essentially doing is guaranteeing the right to buy that stock at a particular price by a particular date. It's a bit of a counterintuitive leap, but nevertheless, it's one you have to make when you're writing short puts. So, Randall, walk us through the writing of the short puts and why perhaps you're not such a fan of them.
Well, I'm not a fan of them because I don't like unlimited risk. It's my nature. I sell someone a put, I have unlimited risk. Having said that, here's a good reason to sell a put short as opposed to a covered right. Let's take AT&T, all right? AT&T at this moment has a dividend yield of about 4.8%. Let's say I sell an out-of-the-money put option that will give me a yield, if assigned, of 5%. And I'm comfortable with that. Selling a naked put short, if you are willing to acquire the stock, is a fine strategy. Don't get me wrong. If I want to capture dividend, AT&T dividend is now, I think it's right around 4.8. And if I sell an out-of-the-money put naked and I get assigned on it, then I get a 5.2% dividend yield. If I'm okay with that, that's fine. We call that a cash covered put.
Now, the short put, it's an interesting trade because a lot of people see it as this very, very risk. You pointed out the unlimited risk nature of it. Well, in essence, it is limited risk because the stock can only drop to zero. But still, that is a long way to go for a lot of underlyings. People don't want to take that journey necessarily. But a lot of people don't think of the short puts as what it is in many ways equivalent to, which is, of course, a lot of our listeners are coming to us from the stock world. Many of them are used to working long limit orders in the underlying. So working, let's say, a limit buy order in XYZ stock somewhere below the price where it's trading. If you're doing that, you are effectively selling naked puts anyway, only you're not getting the income component to do it. You have essentially the same risk profile without any of the upside. So we've talked about this show in the past, and I encourage you to go back, listen to our archives the many different times. Options in lieu of stock is one of them. There are other episodes where we talk about that in a little bit more detail. If you go back to episode 4 or episode 20, both of them we get into writing options and writing puts and some of the pros and cons of doing that. Of course, what Randall's point is well taken, that writing that option does indeed, the put in particular, gives you that risk all the way down to zero. So there are some ways that you could mitigate that. And one of the ways that a lot of people like to mitigate that, if you are concerned about that big drop, is to turn that naked put sale or that option buy, if you want to buy an option, into a spread instead. And now we're talking here about very basic vertical spreads. This is where let's say if you're buying a vertical spread, you're buying one call option, you're selling a strike above it. That's a simple call vertical. Put vertical, if you're buying it, you're buying a put, selling a strike below it, and that is a way to, if you're buying options, to mitigate the outlay, the price of that spread, and the price of that option if you're buying it. If you're selling options like we were just talking about, if you're selling that naked short option, that naked short put, buying that farther out of the money put against it, it's going to reduce the amount of income you're going to collect, but it's also going to mitigate your risk. So if you are worried about the worst coming to pass in the near term and that underlying really dropping through your strike and much below, maybe you shouldn't be writing a put on it, but B, if you are worried about that, then you probably can usually mitigate that risk with a nice put spread, and it allows you to at least sleep a little better at night. So if you're worried about writing these naked puts everywhere and having all this unlimited risk, let's say on a weekend like we had over the last few weeks where we were talking about Syria, a lot of international risk built into the market. Anything could happen over the weekend. You didn't want to be short a naked put during that. You could, of course, buy a put spread, and that will allow you to mitigate your risk. So on the buying side, the basic vertical spread allows you to mitigate the outlay. Instead of buying an option for $4, maybe you buy an option for $4 and you sell one for $1. Now that option essentially costs you $3. Of course, you have limited profit potential as well. That's the trade-off you make when you trade these vertical spreads. One of the other very popular spreads that a lot of people love to use, whether you're a financial advisor or you're a basic retail options trader, it kind of takes the two strategies we just outlined and combines them. It takes the long equity position and the selling a call against it, so the covered call position, and then it also combines it with a long put position for protection. This is known throughout the business as the collar. It is perhaps not the most, but certainly one of the most popular positions out there right now. John, why don't you walk us through the pros and cons of the collar position?
Well, I want to say one thing about the collar position, and there have been studies that have been done on this, and unless you are going to dispute the University of Mass at Amherst study, and I guess an OCC study again, which is the option trade group. So maybe the view there is a little jaundiced. You may take that view, but they had a study. Studies have shown that if you were you're a long equity, hedge fund, whatever it might be, you're a long equity player, and you sell a covered call out of money call and you buy an out of money put, you collar the trade, okay, your returns are going to be greater, equal to or greater than a long only strategy. So it's such a great strategy for the customers that are, I'm a long-term investor. What do? I do covered calls. But Randall pointed out, covered call, you don't have any downside protection. But with this put trade, or this collar trade, now all of a sudden the downside, if we hit some turbulence like 2008 or 2001 or in 2000, you're protected. So you're really going to outperform or mitigate your losses in a down market. And in a rip-roaring up market, you may underperform a little bit, but you know what? You can sleep at night. So I'm a big fan of the collar question.
Yeah, the collar, very, very popular strategy. A lot of financial advisors and asset managers have really embraced that strategy because a lot of them say, the long put, it's just too expensive. I don't want to pay that much to hedge my downside, to hedge my tail risk. But the collar gives them a way to construct. A lot of them like to go for that quote-unquote zero-cost collar, where they find some put on the option chain and then sell some call against on the option chain that are of equivalent prices, so you can net out to an even money trade. It's a very attractive trade for a lot of people. So if you're the long equity guy, you're looking for some protection, but you're kind of worried about how to pay for it, the collar may be a nice strategy for you. There's a lot of other basic strategies we can keep going and getting into. We can get into straddles. We can get into spreads with wings, all these different things. We just are running out of time here on this show. We wanted to kind of just do a refresher, just do a nice primer for you. If you want more on those different things, let's say the advanced spreads, go back to episode 14. We talked a lot about that. It came out January of this year. If you want to talk about straddles, we, of course, did a whole episode of that. Episode 23, the calendar spreads, has been a huge topic of conversation for a lot of you. Our last 3 shows were devoted to those. We just kind of hit on the basic spreads today. Of course, the basic positions, buying a call, buying a put, writing those options, and of course, legging into some simple verticals, and the mother of them all, at least for a lot of equity traders, the collar. And now we're going to keep on rolling right on into our final segment, the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call segment. This is really my favorite part of the show because it's the portion of the show where you guys get your chance to sound off and let us know what you're thinking about and what's top of mind for you guys. This question comes in from Dave S. He's writing in about some of our more recent episodes where we discuss calendar spreads. You guys can't get enough of those episodes. So many great questions and comments coming in about those episodes. Keep them coming. He writes, in the Options Bootcamp podcast 28 and 20, we discussed buying deep in the money leaps and selling shorter term calls against them. If the calls you sold expire worthless, everything is great. What happens if the underlying goes up and the calls you sold are in the money at expiration? Is it better to just buy back the calls or let them get exercised? Can you discuss the process if they are exercised? Do I need to sell the leap to cover the call that was exercised? Great question, Dave. This, of course, refers to a strategy I've outlined several times on this show. We talked about the covered call here today. This is a way to kind of jazz it up a little bit, improve your returns, improve your Greek's profile of that trade. Instead of buying stock and writing, let's say, a 1 month or a weekly call against it, you're changing it up and you're buying a longer term, 6 months, perhaps a year, perhaps even longer, depending on how you structure it, in the money call typically, and then writing a front month or a weekly call against it. And then now you've essentially put on a diagonal time spread now, which is why it comes into play in some of these time spread episodes we were just talking about. But what I think really blows a lot of people's mind, and Dave is referring to this, is when you put on the covered call position, people are safe with that, or they feel comfortable with that because the stock can get called away, and they have the stock for that to get called away. So they know what happens if the underlying rallies through their strike. The stock just gets called away, and they set it again the next month. With this position, it's a little bit different because you don't have the stock. You have the long in the money call, the long leap call instead. And that can be a little bit confusing. So Randall, why don't you walk Dave here and the rest of our listeners through some alternative scenarios that they can employ when they have this position on and the underlying rallies to or indeed through their strike?
All right, let's look at this strategy. Let's look at it. It's basically a covered right, but instead of being long the stock and short the call, we're long a longer term option, a leap, and short the call. It's a bullish strategy. Don't forget that. If the stock drops more than you get for the call that you sold, you're going to lose money. It's a bullish strategy. There's no other way to look at it that. Okay, so fine. So let's say it works your way. What you want, of course, is for your short-term call to expire worthless and not drop too much and write another call. But let's say the stock rallies. Let's say your short-term call looks to finish in the money. What do you do then? Well, you don't want to be assigned on the short-term call, because then you're going to be short stock, long call, and that's not a bullish strategy, that's a bearish strategy. It's a synthetic put. You don't want that to happen. So what I would say is take the position off, buy back your short call, and sell your long-term call. You don't want to exercise your long-term call because you'll be throwing away a lot of time premium. And if your short-term call expires in the money, it was a bullish strategy, so you'll be able to unwind it for a profit. That would be what I would say.
All right, thank you, Randall. And you're right, Randall, you don't, first and foremost, Dave, you do not want to exercise that leap, because Randall's right. You have a lot of time value built into that long-term option, as we've discussed on this show many times in the past. If you go back to some of our earlier episodes, the basics will run you through that, of course, that concept of time value and how once you exercise an option, you lose all of that. So you're much better off in that scenario always selling that option, unless the one scenario is, of course, if there's a dividend, but we're not talking about that here. So in this scenario, you are never well served to exercise that long-term option. Keep it in there. And Randall's right. It's a bullish strategy, so if it runs through your call, that's a good thing. It's working. And now you have a few alternatives there. You can, of course, if you want to keep that position on and keep rolling it, you can buy that call you're short back and write a longer-term, farther out of the money call, give you a little bit more wiggle room to play with there. Or, of course, you can let that short call go and let it be exercised. And, of course, you have a short stock position, and then you have but it's been offset by the gains you've made in that long leap position. Of course, that's not a desirable thing to do, because then you have some margin issues you might encounter with the short stock and then this long leap you have there. So you're probably, in most scenarios, I would recommend, if you want to keep this position on and keep generating income, you buy it back and you roll it to another call farther out. Let's say you sold a 5% out of the money call, the underlying rallies to that strike, maybe a little bit through it, you buy that back, take a little bit of a hit on that call, but then again, remember, you've made money on that leap as well, so you're usually offsetting the bulk of those losses, and then you're rolling it up, let's say, to another 5% out of the money call. You can keep doing that over and over again. And one of the nice things about writing these shorter term calls is it allows you to adjust. If you're writing weeklies versus a 1-year option, you really only have that 1 week time span to worry about. And so if the underlying rallies, then you can always buy it back and do it again the next week. And usually you're going to have a lot of scenarios where the underlying is not going to do that. So you can continue writing those calls time and again. But people always write in with variations on this question about what happens if I break through the strike, and what happens if I get assigned or if I get exercised. I just want to stress to you, that's not a bad thing. That means your strategy is working. It is a fundamentally bullish strategy. You want the underlying to rally. There'd be times maybe where it might be nice to just sit at that strike and go out, so you don't have to worry about some of the other mechanical issues that go into rolling and things. But fundamentally, this is a good thing, and that's something you should be encouraging and looking for in your trades. And in most of these scenarios and what you're outlining here, I would definitely roll the call. Do you need to sell the leap to cover the call that was extra? That's really going to depend on the amount of cash you have in your account. John's the margin guy, but essentially, you may, if you have to you're going to establish a short stock position now. So if you don't have enough capital in that account, you may have to sell that leap to do that. So that could be a downside to that, again, which is why I would encourage you to roll that call as opposed to let it get exercised. Because once that happens, you have all these other margin considerations. You're going to pay these fees for exercise and things like that. It's not the easiest and most desirable of scenarios. If you want to maintain that position and keep it going week after week or month after month, you're going to have to get comfortable with rolling those calls. So once you get a handle on that, maybe you set up your own system. Whenever it breaks X amount through the strike, I'm going to roll it. Whenever it gets close to this strike, I'm going to roll it. I've seen some people who love to write in the money calls for their covered calls. They want to capture that extra level of volatility premium in the put wing of the volatility skew, and so they roll their calls all the time because they're writing in the money calls on a regular basis. Their stock's getting called away or their options are being called away all the time. So it's an interesting scenario. It really depends on how you like to trade, your own risk tolerance. For me personally, when I do these types of trades, I tend to roll the calls. It's just an easier scenario than having to deal with the exercising, having the short stock, having the capital in your account to cover it. Do I need to sell this other position? Maybe you have to sell some other positions you have in your account to cover this short stock position. It's not a desirable scenario. I would encourage you, if possible, to roll the position and keep doing it. And you will get the benefits of this long-term call. Remember, we discussed that gives you a delta now, a delta less than 100. So if the underlying drops, you're getting the benefit of a lower loss rate in the underlying. You have a Vega component now, so as the underlying drops, you have that Vega component increasing. That's going to offset some of your losses as well. So there's a lot of different reasons that a long-term call, a leap in this case, is preferable to the underlying. As long as you can wrap your heads around some of these mechanics, it's a very attractive trade. Just get comfortable rolling your short-term calls, and you should be all set. Great question, Dave. Thanks to everyone else who wrote in. We'll get to you again on another show because we kind of ran long. But that is going to do it, unfortunately, for this episode of Options Bootcamp. I want to thank my cohorts here on the Options Bootcamp Drill Instructor Squad. Starting off with you, Randall, the newcomer. What is cooking over there in the land of Randall Liss, and where should our listeners go if they want to learn more about your educational content and what you have to offer?
Thank you. Thank you very much, Mark. My website is www.thelissreport.com. I update it every day. I'm an options educator. I am not an advisor. I have no clue if we're going up, down, or sideways.
Those are the best kinds of educators because they're not out there selling you snake oil in terms of their guru pick services. It's just here's what you think. Okay, here's how you can express that using options. That's what we always look for here.
Exactly. Thank you, Mark.
At the Options Insider. And that's why we wanted to bring you on the show, Randall, to showcase you to our listeners and let Mr. Dan know that we can ably fill in for him when he's off gallivanting around the world. And last but certainly not least, Mr. John, what is cooking in the land of SogoTrade.com?
Well, we're working on some always exciting new things. We're working on some new charting capabilities. We just started the project, so it's going to be a ways off, and we're still always working on the margin. I'm beta testing it, and we found one little quirk in it, so now we're retesting again. We want to get this right for all our customers, so that's imminent. Even though I've been saying that for a while. We should be rolling that out pretty soon, and you can always follow me on Twitter and Facebook. And I want to thank Randall for filling in for Dan. It was a pleasure speaking to him today earlier and having him on the show. So we'll see you guys all next time.
Really quickly, why don't you give our listeners the Twitter and Facebook handle so they can follow you?
Well, it's Sogo Trade Option is Twitter, and then the Facebook is SogoTrade.com. And we have our blog, I post some articles on our blog, and occasionally I'll also post on the Option Insider. So you can find me there.
Yeah, so go ahead, follow John, follow the guys over there at Sogo Trade. Let them know you listen to the show. Let them know that you like it. Ask John some questions. You can even send some questions to John for the show there that we can answer there. So a lot of great ways you can get in touch with us if you want to join your fellow listeners here on the old mailbag segment. Of course, you can leave us a comment on this show notes or on the show listing on the optionsinsider.com, or of course you can find us on Twitter or find us on Facebook or find us the old-fashioned way, questions at theoptionsinsider.com. Just send that in. Of course, be sure to put in the subject line the name of the show you'd like to have your question answered on, and we'll do our best to route it to the appropriate show. And on behalf of Randall and John and Mr. Passarelli, who's gallivanting around the globe, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and for writing in with such great questions. Keep them coming, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.